Welcome to the InterMarket Analysis Update, where we'll look at other markets in addition to the stock market and other indexes, just to see how things are interacting with each other, to see if we can get any clues as to what is happening in the stock market itself. This is being recorded Sunday, October 16th, and this will apply to the market starting for October 17th. The first thing that we like to look at is a thing called valuation. And this is, are stocks considered to be fairly priced or cheap or inexpensive? A lot of times, fundamental investors will use that as their gauge for determining if a stock should be purchased. If that's usually when it's considered cheap, or when it gets to the point where it's considered expensive, that is usually when a fundamental investor might sell. Well, we can also use that approach if you combine that with technical analysis. And that's what I do in my program. And I'll be going through a lot of different charts to bring those two things together. The first thing that we look at is just how is the market valued right now? The black line that you see is the S&P 500, and we hit the top in early January and have been coming down, and we've dropped below this red line. The red line is a PE ratio of 20, and that's a static number. When we're above 20, that's considered to be expensive. When we drop below that, stocks are still expensive, but they're not as expensive as they were before until they come down to the blue line, which is in the middle. That's a PE ratio of 15, and that's when stocks are considered to be fairly valued. If we ever get all the way down to the green line, that's when stocks are considered to be inexpensive or cheap. The chart down below just shows the difference between the S&P 500, the black line, and the red dashed line, and it just shows how we've dropped below that after being pretty extreme for quite a while. Here's another chart showing the same basic thing. Now, the one thing I'll warn you about with this chart is these little lines are based on a thing called TTM, or trailing 12 months. This is looking back. These are earnings reports that have been released, and they have to fulfill guidelines. And so we can look back on a historical basis to see where are stocks now. And you can look, going all the way back to 1980, the different events that have happened and how stocks were valued during those events. Another thing that the stock market really likes to use is a thing called forward PE ratios. We look backwards to get the trailing 12 months. Well, this looks forward, usually the next 12 months. And that's what the stock market uses. The stock market doesn't look backwards, it looks forward. Well, when you take, even though earnings have been revised down and the S&P has been coming down, the PE ratio has been declining, and we're currently at 15.2. So on a forward-looking basis, stocks are considered to be fairly priced right now, and that could justify things going even higher. Now, if the S&P continues to fall and or the earnings per share looking forward estimates, if they can both continue to fall, either one or the other, this PE ratio can continue to decline. So we just watch this kind of on a bigger picture basis just to get an idea of how the market is looking going forward from here. Usually I've been covering a thing called the possible positive scenarios. Well, we're in a downtrend now, and these scenarios just are not that relevant until we see follow through with price action. They're valid and we do keep an eye on them, but until we see prices actually start to turn and go up, these scenarios are just not applicable to us. So I'm not going to cover those in this video. I do go over them every day in the daily video updates that I post. The first thing we look at is growth and value. Growth has really been suffering in 2022, and values even had some difficult times, but value continues to outperform growth. Growth are the stocks that you want to buy low and sell high and see a lot of capital gains, and that's what really helps the indexes go up. Value are stocks that maybe they're older companies, maybe they're more old school with how they do things and the products that they provide, not as flashy, not as fun to talk about at parties, But when the market starts to get into trouble, people tend to get out of the growth stocks and get into the value stocks. Well, this is showing where the growth index all by itself continues to be in a downtrend and is coming down to what could have been a previous bottom. So right now we're at a support level with growth. We want to watch this. Are we going to be able to hold on to this support level and then turn and go back up? Right now we're decidedly headed lower. Values also had some trouble. It's been going down, but not as much as growth. It has come back and actually broke through previous supports, but it hasn't come down to more short-term support yet. So it's been holding up better recently. When you do a ratio between the two, this just shows how growth has been underperforming. This is a growth against value ratio. The bottom chart is value against growth and how value's been outperforming and is still in an overall uptrend. Then I have a number of charts looking at indexes and ETFs in different areas just to compare growth with value. This is an index showing how growth has been underperforming value. And we were almost getting back to the point where we could have seen a golden cross. Well, lately we've been seeing some weakness here. And so that's showing that growth is starting to underperform again. This is a flip-flop or an inverse of that same chart showing how value, after showing some weakness, has now been showing some strength. Here's another look using ETFs, seeing pretty much the same thing where we were trying to bounce back up, but now have been coming down. Here's an inverse of that same chart where value had shown some weakness and now it's going back up. Here's another index showing how growth has really been underperforming value. So we're seeing this in pretty much all the charts right now. Some other markets, we have the 30 biggest software companies in the US. They are in a downtrend and could possibly be getting ready to break through support. This is a monthly chart of the CRB index on top, which that helps us measure inflation. And it's been showing some weakness now, and there's actually a change in this chart. On the daily chart, we've switched over and have had a bearish or death cross is what you call that. But on the monthly chart, we're still in that uptrend for right now. We compare that to the chart on the bottom. This is when this chart is going up, that means inflation is really going up. When this chart is going down, that means there's deflation. And we've been actually declining now for quite some time. I'm not quite sure what to make of this other than the fact that, yeah, we have inflation right now. There's no doubt about that. We had the CPI come out showing that inflation is strong. But is this possibly suggesting that the inflation may morph into deflation in the future? Which, if you think inflation's bad, deflation could be even worse. That's just a thought right now. I'm not predicting that or saying that, but we are hearing some talk about that. And according to this chart, that could be likely. Another thing that we look at is the Baltic Dry Index. This is what does it cost to ship goods from point A to point B. If the costs go up, they have to raise their prices. When they raise their prices, the stocks that make up this index tend to go up in value. Well, lately, we've been seeing this really start to come back, even though it's still in an overall downtrend. This is the one that's just changing here. This is the CRB index, and this is a daily chart where we had been in an uptrend for 2021 and 2022. We've dropped below the red moving average, which is a 200-day moving average, and the blue line has just crossed over the red line, and that is considered to be a death cross. A lot of this can be attributed to the strength in the dollar. As the dollar's been going up, commodities have really been suffering. As long as the dollar was weaker, that let commodities go higher because most of these commodities, they're exchanged in dollars. And so when the dollar is really strong, that hurts the prices of commodities. Just to give you an idea, here are some commodities that I like to look at. Here's corn, which was actually, it had been coming back down and it's been rebounding. Aluminum, which really spiked up a number of months ago, has been really falling ever since then. So that's more, could be considered deflationary. Heating oil, which we're starting to get into the colder months now, it's still quite high, but it isn't really spiking up. the way it was before. Gas has really been coming down. And this is what politicians, they're fighting like anything to keep the gas prices down, because we have an election coming up in a few weeks. And this is what people see. When gas prices are really high, that's like an additional tax, and they want to blame the politicians for the high prices. And then what the politicians do is they blame Putin for everything. Well, when everything is coming down, then they take credit for that themselves. But then when it's going back up, it's like, oh, okay, well, maybe we need to find someone else to blame. That's just a political game that's always gone on and will continue to go on. But gas prices are well off of their highs, but they still could go back up pretty easily. Natural gas, another thing that really spiked up and has since been coming back down. Here's oil. It's down around the 85 level. It had gotten all the way up to 130. Well, then it's been really dropping back down since then. It has been lower than this, and it's been rebounding slightly, but still it's not as high as it was. Wheat, another thing that we kind of have to have for our food, it's been declining over the last few sessions after really spiking up high. Another thing we look at is the price of fertilizer. I don't have the same kind of chart for this. I go to a Bloomberg chart where fertilizer prices really spiked up and then have come back down, and they continue to decline. But on a historical basis, they're still pretty high. And this is also inflationary because you have to have fertilizer to grow things. And if the price of fertilizer goes up, then farmers have to raise their prices, and then that ultimately works through to us. Another thing that has been in a pretty severe downtrend ever since 2022 is lumber. It's been seeing some recent strength. It's been bouncing back up a little, but it's still in an overall uptrend. We'll want to keep watching this to see if it breaks this trend. And this red line is not a trend line. This is just to show you the direction that things are going. But are we going to break through what could be a trend line on this chart? Dollar. This is what's been causing a lot of problems, not only to stocks, but to commodities. The dollar's really been going up. It's also very strong when compared to other currencies, especially the euro. The euro has really been in decline as the dollar has been going up. And the Japanese yen has also been in decline as the dollar's been going up. So here's both of those currencies. Another one that's been in the news lately is the British pound, where they're having a lot of problems right now with, are we going to have stimulus packages, which is basically quantitative easing, after they said that they were going to fight inflation. So there's this tug of war going on of, do we try to help the economy or do we try to get inflation under control? Because you can't really do both at the same time, although that's what the US is doing right now. The Fed is really raising interest rates to get inflation under control. Meanwhile, Congress is passing all these bills, the Inflation Reduction Act, which is the opposite of what it's named. And that's sending all this money into the economy. And so these two forces are really butting heads with each other, and we'll have to see how things play out. Copper, which we tend to look at for, it's called Dr. Copper. If copper's going up, that's projecting a brighter economic future. If it's going down, that's more of a negative one. Well, lately, after falling, we have been going sideways for the most part. So the copper is kind of non-committal right now. We also take a copper to gold ratio, which shows that gold has really been suffering, and it's been outperforming gold on this ratio. And then here's a longer term look at that same chart. That's the black chart right here, showing the ratio. And then we compare that with the 2-year yield, which just keeps going up and up and up. And the 2-year, that's giving us the best yield right now. It's given us more than the 5-year, the 10-year, the 30-year yield. And that's also indicative of a not very good economy. Gold, which I just mentioned, we came up to this 50-period moving average and have since been declining. And the blue line is below the red line, so we're still in a downtrend. And silver, after looking like it was going to break out, broke down and is also in a downtrend. Looking at some other indexes, this is the CRB, or our inflation gauge, against the S&P. Shows how the CRB had been doing well, and it's still outperforming the S&P 500, but it's not as strong as it had been. This is an inverse. showing how the S&P has been underperforming the CRB. And we'll have to see if the S&P finally finds some support and starts to go higher. That will help this chart go higher as well, if that happens. If we see the S&P continue to fall, this chart will probably fall as well. Then we look at the Nasdaq 100, which is growth, and we compare it to the S&P 500. And this just shows again how the Nasdaq 100 has really been underperforming the S&P 500. Here's some other stock areas to look at. These are the really big, usually tech companies in here, and they are having some weakness right now. They have been in decline and are in a downtrend. The S&P 100, the biggest stocks in the S&P 500, over the last few days, they've actually been performing better than the rest of the S&P 500. And we saw that in Thursday's big advance. It was the Dow that led things higher. It was value that outperformed growth on Thursday. So we just want to keep an eye on that, because it's when growth and growth stocks are really starting to perform well, that's when the market tends to do better. There's small caps, which had been showing a bit of a breakout here, even though some recent weakness. This sometimes, when this ratio is going up, this can give some support to the S&P. Also, low volatility stocks. These are the more safer stocks that people get into when the market's having trouble. Well, even low volatility stocks are now starting to go down, but they're not going down as much as the growth stocks. And then here's a ratio showing how the low volatility stocks continue to outperform the rest of the the S&P, even though low volatility stocks have run into some problems. Here's an average that takes the Dow, the trannies, and the utilities together and combines them. This just shows that all three of those, when taken together, are still in a pretty significant downtrend. Here's a thing called Dao Theory. Most people just use the Dow and the transports. I include utilities, where we're seeing the declines in the Dow and the transports. Those are kind of matching each other right now. There's a few little divergences here. The thing that I really noticed is just a few weeks ago, the utilities were holding up very well. Well, they've just been coming down pretty strong. And they were the last to set a new 52-week low. Then the FANG stocks, these are the big companies, Facebook, well, we now call it Meta, Amazon, Apple, Netflix, Google. These are the big growth stocks. Well, they continue to be in a downtrend. ARK, which is something that a lot of people get into for an ETF, it seems like it just, anytime it gets some support and tries to go back up, it seems to give all of that back and then even more. So it's been really suffering since hitting its all-time high way back here, which seems oh so long ago. Looking at bonds, we want to keep an eye on the bond market, where bond prices have really been in decline. And that's causing interest rates to go up. Interest rates and bond prices move in opposite directions. Here's a world bond index showing that we broke through the COVID lows and we continue to go lower as interest rates continue to go higher. We look at a ratio of stocks to bonds on a monthly basis, and so far for the month, this is advancing, which means even as bad as stocks have been doing, they've been doing better than bonds on a relative basis. But if you look at the shorter term maturities, the 7 to the 10-year bonds, they have actually been outperforming stocks. And if you think about that, the 2 years been giving us the highest yield. So even though this is 7 to 10 year, there's been a lot more support with the shorter term maturities. We also look at a correlation between stocks and bonds. And when this number gets, the closer it gets to 1, that means that they're moving in the same direction. When it drops below and gets to -1, it means that they're moving in opposite directions or have an inverse relationship. Well, right now, stocks and bonds are going in the same basic direction. We're seeing a breakout with the yield on the 10-year. It finally went above 4%. Looking at corporate bonds, a lot of folks like to get into those as well. Well, based on price, they continue to be in a real downtrend. And since the bond prices are going down, that means that the yields are going up. The 30-year, it's less than the 10-year right now, but it's just under 4% at 3.99%. Then we look at the S&P 500 against the 10-year yield, and this just shows how the S&P has been underperforming as interest rates have been doing better. We look at junk bonds. These are bonds that folks get into that give you a higher yield, but with that higher yield is also higher risk. When these are going down, that is not necessarily a good sign, and junk bonds tend to follow the stock market. Here's a ratio between junk bonds, the risky bonds, and treasury bonds, which are considered very safe. Even though both have been really struggling lately, junk bonds continue to outperform treasury bonds. And here just is showing the yields. This is a daily chart with the blue line on top. That's the 2-year yield. But overall, interest rates have really been climbing. This is a weekly chart looking at international bond markets where the UK, they're having a lot of problems there. And so they've jumped into first place. They've been really raising their interest rates where the US had been in the lead for quite a while. Well, now we're in second place. And then you have Germany, which has also been raising their rates. The red line along the bottom, this is Japan. They're having a lot of problems in Japan, but they're slightly different than what the rest of the world is dealing with right now. They're still trying to stimulate their economy, but this could become a real issue into the future. And I'm keeping an eye on this. And there's just other things that the market is really fixated on right now. But the situation in Japan is something that may come to the forefront at some point. Looking at some sectors, this is giving us a little bit of hope. If you want to pause this and look at this, see when the S&P to utilities ratio, when it's going up, the S&P is going up. When this ratio is going down, the S&P is going down. And when we stop and then turn around, that often will mark a bottom for the S&P 500. Well, we're seeing that. We bottomed out with utilities because they've been going down. And this has been showing some improvement, but we're not seeing any follow through based on price. Two things will have to happen. One of two things. Either the S&P will need to find some support and start to go back up, or utilities will eventually find some support and they will go back up, and this chart will start to go back down. Staples, another thing that people tend to get into when the markets are having trouble. Well, staples are in an overall downtrend right now. Then we look at energy, which that's been going up and up and up compared to the S&P. It shows that energy has really been outperforming. The tech sector, this is where a lot of growth comes from, is still in an overall downtrend and continuing to decline. Semiconductors, a big part of growth, they're also in a pretty solid downtrend. Then the tech sector against the S&P shows that tech has really been underperforming the rest of the S&P. Some other areas, this is growth, which has really suffered a lot, and bonds, which has really suffered. They're pretty much right on the moving average right now. They're kind of in a neutral area currently with an overall uptrend to growth. Looking at the 10-year yield against technology, this has gone up as interest rates have been going up and continues to be in a solid uptrend. Here's an inverse of that same chart showing how tech has really underperformed the rise in interest rates. Discretionary, the things that you would like to buy, compared to staples, the things that you need to buy. Well, discretionary has really been underperforming and continues to be in a downtrend. Here's an inverse showing how staples have been outperforming. Energy to tech, well, energy's been doing really well and tech is not, so that's why this chart is really going higher. Gold, which has not been doing very well compared to the S&P, as much as gold has been suffering, it's still been outperforming the S&P 500. Then we look at gold to the dollar. Gold's been going down, the dollar's been going up, so that's why we're seeing a real decline in this chart. High leverage loans, these are riskier loans, and when these start to go down, that could mean some economic problems. We are in a downtrend, but we have not broken through support yet, at least on this chart, but we'll want to keep an eye on this. Here's looking at a lot of different markets taken together. Even though oil has shown some recent weakness, it's the best performing area of the market in 2022, followed by the dollar. And then we have gold, which everybody's convinced is going to go to the moon, but it just keeps going the other way. And someday it will. Someday gold will really rise up. And then we have stocks and bonds, which are negative going back to the beginning of the year. When we take the American Stock Exchange, the Nasdaq and the NYSE, and then we take a 5-period moving average of their highs minus their lows, we're right down here. We're showing some weakness yet, and we're not necessarily extreme. We sometimes use this as a setup where we have an extreme negative reading, and then if you look at this, sometimes that marked a low in the S&P 500. Hasn't really signaled a new extreme yet, so we want to keep an eye on that. So this is just overall negative right now. Small caps holding up better than some other areas in the market, but we have dropped below this pivot area and we continue to be in a downtrend. Mid caps, which have been holding up just about the best of anything right now, they're negative too, but they've been doing better than some other areas. The Dow, which really led things higher in Thursday's advance, got back above this pivot level. Well, with Friday's decline, we have now dropped down below it, and the Dow is in an overall downtrend. The Nasdaq also is in an overall downtrend, and then the Nasdaq 100. Those charts look pretty much the same to each other. The Wilshire, which is a broader measure, is also looking at what could be potential support in here. And then looking at all stocks in the US and then internationally, we continue to be in an overall downtrend. Emerging markets, a lot of folks like to invest in those markets. Well, going back to 2021, they have been in a pretty significant downtrend. Internationally, showing that China is down. The emerging markets, they're trying to turn with this indicator, but they're still headed down. We're turning up slightly in Europe right now, and we're turning up in Japan, and we're kind of flat right now with the S&P. Could this suggest that things might get a little better in the stock market? Bitcoin, which has just been floundering a little bit above, a little bit below 20,000. That's really where it continues to be. Some correlations. We like to look at these because typically in intermarket analysis, some markets tend to move in opposite directions where other markets tend to move in the same direction. Well, this is just showing that the S&P and the dollar are going in pretty strong opposite directions right now. And the S&P 500 to oil, this is neutral. When we're at 0.25 to minus 0.25, I consider this to be neutral, but we are declining here. So if this continues to fall, they'll have more of a tendency to move in opposite directions. Here's the S&P to interest rates, pretty strong inverse correlation. The tech sector, growth against interest rates, they're having a pretty strong tendency to move in opposite directions. Here's the S&P to the 2-year. It's not as really strong of a relationship on an inverse basis, but still, they're tending to move in opposite directions. So, and I actually made a few changes on here. I added one thing like the US dollar. I hadn't included that on the list because that's usually a money market. That's usually what people are just in while they're waiting to decide what they want to do. But I added this on there because the dollar has been performing well so far in 2022. So it's positive. Energy continues to be positive and interest rates continue to be positive. I took the CRB index off of here because we saw the death cross. And then we look at all of our different things here that are negative, which is pretty much everything else right now. So thank you. I hope you find this helpful. Please feel free to check out the daily video updates. I also post a weekly video update, and I'll look to prepare this video again next week.